Welcome to another session of Personal Finance Training. Today we're going to talk about credit card. This is presented by Accounting Mentor. Like, share, subscribe. Our aim is to get a better understanding of credit card management. Today we're going to talk about what's a credit card and limits, debt growth with an APR of 18%, with a debt of $8,000, what's the balance after 12 months, the revenue percentage change or the growth rate, which is between 1 to 2%, and we're going to explain that, return on loan after 6 months or 12 months. Now let's define what is a credit card. A credit card is a thin rectangular piece of plastic or metal issued by a bank or financial service company that allows cardholders to borrow funds with which to pay for goods and service which merchants that accept cards for payments. There's further explanation on this web page, but we'll need to look at this at another time. Now let's have a look at this principle here. Now we're going to look at various limits in terms of the card. So here we're going to start off with looking at banks. Banks tend to have lower limits of 1,000, and we're going to talk about it in terms of the UK and the US may have different limits, but here in the UK we're looking at, these are some of the typical limits we may have. So in terms of banks, we would start off with about 1,002, and this could go up to 40,000, even more than that. Based on your income. I mean, if you are a millionaire, your limits could be even higher than this, 100,000, depending on it. If you're a billionaire, it could be even further. But I'm assuming if you are a millionaire or a billionaire, you would try to be more prudent in terms of your credit card, because it could even go into exponents. But we'll talk about that later on. But what is significant here is that APR is 49.8%, and this is Santander. And they're saying here that in terms of balance transfer, there's no restrictions on that, and for the first 12 months, 0%. Now let's have a look at mortgage companies like, say, NatWest. Their lower limit is about 1,002, upper limit about 50,000, and again it could go up to hundreds of thousands, based on the fact that if you have a property and there's equity in the property, I think the bank will feel a little bit more comfortable lending you money, because your situation is of such that you may be able to use it to pay back funds, providing you run into financial difficulty. There's also no restrictions in the balance transfer. Again, you have 12 months free if you transfer your balances from one bank to another. And then we move on to supermarkets like, say, Tesco. Their limits would be between, let's say, 1,200. I think there isn't a difference between the upper and lower limits. I don't think they tend to extend further into the few thousands, because of the fact that I think the purpose is for you to actually have money for food shopping and not necessarily to do other things. So that's the intent. And also balance transfer, they offer 95%. So let's say for the 1,200, you can only transfer up to 1,140 thereabouts. Okay, and they're happy with giving you 0% for 12 or 9 months. So that's typically what a Tesco scenario would look like. And then we move on to hardware like Homebase. Their limits between 500 to 3,000. Again, this is to buy household related fixtures and fittings, etc. And what is also good about this is that it's 18.9% APR. So it's the best in terms of APR. Again, 0% in terms of balance, no restrictions in balance transfer, and 0% up to 12 months. But we're going to talk about what it means in terms of calculations. Now let's have a look at the calculation. This is the interesting bit where we talk about the calculation, because this is really like what we really want to know, what is going on. Now, let's say you were to borrow 8,000 with a typical APR of 18%. Now, let's break down what the figures are going to be like if this were to be the case. Now, if you borrow 8,000, after 3 months, 8,000 is going to change to 8,612. So about 600 pounds, the debt level will increase to after 3 months. Let's look at what would happen after 6 months. That's in purple, and that is 10,470.99. So again, a few thousand, it seems, the debt levels increase from 8,000 to 10,470. And then after 9 months, it's 14,399. So even more thousands being added to the debt. And when we get to 12 months, it's 22,468. So we can see here, the debt is almost doubled over that period from 8,000 to 22,000. Really handsome return for banks and financial institutions. But let's have a look at the dynamics of this even further. Let's look at some graphical display of this. And here we can see in terms of the graph from 8,000, after period 1 is 8,089, then 8,002, then 8,006, and 9,096, 10,004, 11,4, 12,7, 14,3, 16,4, 19, and then 22,4. So we can see the trajectory of it here, moving from hovering between 200 growth between, or difference between period 1 and 2 to about 2,000 or thereabouts, difference between period 11 and period 12. Now, there's an interesting bit of information we need to look at here in terms of the percentage growth rate here. Now, what we want to know is how the revenue of the banks or the financial institution is growing over a particular period. So let's look at period 2. So from 1, period 1 is the base. So we can't look, there's no difference between the base because the base is the core. But let's move on from the base to, let's say, the next one, which is period 2. So from 1 to 2, we can see that the growth rate is 2%. And then from 2 to 3, it is 4%. And then from 3 to 4, 5%. But let's have a look at it even more closely. You can see the difference between 2 and 4 is 2. And then the difference between 4 and 5 here is 1. So we can see the growth rate is hovering between 2 and 1 for the first 3 periods, let's say 4 periods. But when we get to period 10, 11, and 12, we can see it's 14, then it goes to 16, and it goes to 18. So we can see as it goes into the upper trajectory, into the latter stages of the year, it goes into double digits in terms of the growth rate. And what that's saying is that the revenue for the financial institution is growing at 2% every month, which is excellent. And now we're not talking about every year, we're talking about every month. And whenever you have a scenario where there's a growth rate of 2 or even 1% every month, that's an excellent scenario, because that is what you would want in terms of return, for return purposes. You want your revenue to grow, and it to be an upward trajectory of growth. And we can see here that revenue growth is not, trending downwards, it's trending upwards, which is very good for banks, but terrible for borrowers of funds of this nature. And we can actually see it on a graph here. We can see that the line is actually straight. So, then representing the idea of the 1 to 2% every single period with the rate of growth. Now, let's have a look at the figures even more closely in terms of looking at times. Now, after 6 months, 8,000 is gonna yield a return of 1.31 times, which means that if we were to take away the 1, it's about 31%. So the percentage change on that is 31%. So wherever you have a scenario where you get a return of 31% in 12 months is excellent. Or in here, it's 6 months, or even 12 months. Is 6 months is excellent. That's far greater than any return. Even in some instances in the stock market, you might even struggle. There are some, rare scenarios where you may get even far greater return than that, but it's a relatively good return. Now, if we were to adjust for the rate of inflation of 2%, so we take away 2% from that for the 31%, and that gives us 29. So even after 6 months, the financial institution is getting a return of 29%, and that is just only 6 months. And the debt level would have increased from 8,000 to 10,470. And if you were to find a difference between that, that would be 2,470.99 return for the lender. So the lender is actually getting 2,470 just after 6 months. Now let's have a look at what happens after 12 months. In terms of times, it's 2.81. And if we take away 1 from that, that's 1.81 times, or 181%. So for the 8,000 put in, you would get a return of 181% of that. Now, if we were to again adjust for the rate of inflation of 2%, if we adjust for that, that's 179%. So again, we can see quite a significant return, almost doubling that which debt was in the very beginning. And we can see here, and this is just the return. So we can see here 22,468, and if we find a difference there, it's 14,468.03, and that's the return for the lender. So the lender is actually pocketing 14,000 from a debt of 8,000, and after 6 months, from a debt of 8,000, pocketing 2,470. So we can see it's the longer this continues, the more the lender gains and the borrower suffers. And this is the trap that credit card puts generally people who are going through financial difficulties in. If it is not managed well, you will have a situation where it gets into exponent. Once it passes 6 to 12 months, it's big trouble. And a major shift needs to take place in order for you to actually get this under control. So yes, so we've spoken about what is credit card. We've spoken about credit card and the limits. We've also spoken about debt growth with an APR of 18%. And we spoke about scenarios relating to 8,000 and how it has changed. As we said, from 10,000 now about 6 months, and then to 22,000 about 12 months. We've also looked at the revenue growth. We said the revenue tends to grow about 1 to 2% in the very early stages, between 3 to 4, 5, etc. And then when it goes to the latter stages, it has a steady growth of 2%, which is quite significant for the lender, but bad news for the borrower.